As of this moment, Plug Power Inc. is trading at $3.48 per share, a staggering drop of 37 cents, which translates to a 9.61% loss on the day. Now, the common expectation when a stock like Plug Power experiences such a dramatic intraday swing is to simply label it as typical volatility for a high-growth, speculative, clean energy play. Many investors see this and think it's just the noise of the market, the ebb and flow of a sector tied to complex government policies and long-term promises. But the reality of today's price action is far more specific and concerning. This isn't just broad market sentiment. This is a direct, calculated response to the immense pressure on the company's balance sheet and the market's growing impatience for tangible profitability. The narrative has always been about a future hydrogen economy, but the reality reflected in this 9.61% drop is about present-day cash flow and operational execution. The market is no longer just buying the story, it is demanding to see the math add up, and right now, the numbers are causing considerable anxiety. This kind of sharp decline sends ripples across various investing platforms. Traders using sophisticated tools on the Interactive Brokers platform are likely running models to find a floor, while newer investors on the Robinhood app might be seeing alerts and wondering whether this is a dip to buy or a signal to get out. The trading volume today has been immense, far exceeding its daily average, which tells us this isn't a quiet drift downwards. This is an active, aggressive sell-off. Large blocks of shares are moving, suggesting that institutional funds, not just retail traders doing some self-investing, are repositioning themselves. This isn't like the relatively steady movements you might see in an established giant like Apple stock. This is the raw, untamed behavior of a stock whose fate hangs precariously between massive potential and significant operational risk. When you manage your portfolio, whether it's through Fidelity Wealth Management or a self-directed SoFi Invest account, understanding this distinction is absolutely critical. Plug is not a set-it-and-forget-it stock. It demands constant vigilance. The central tension for Plug Power right now revolves around its ambitious expansion and its ability to finance that growth without endlessly diluting shareholder value. The company is building out a green hydrogen production network across the United States, with plants in Georgia, New York, and Texas. The expectation was that these facilities would come online smoothly, begin producing hydrogen, and drastically lower the company's fuel costs, which have been a major drain on its finances. The reality has been a series of delays, cost overruns, and logistical headaches. These operational hurdles are what spooks serious investors. They look at a company like Nvidia stock, which has a clear path to monetizing its technology, and then they look at Plug, which is still in the expensive, uncertain building phase. This contrast makes the risk profile incredibly stark. The recent news cycle has been dominated by discussions around the finalization of a massive loan guarantee from the Department of Energy. The expectation is that this loan will provide the necessary capital to complete their projects. The reality is that any delay or any unfavorable condition attached to that loan could be perceived by the market as a major setback, and that uncertainty is what is fueling today's sell-off. Let's ground this in what the company actually does. Plug Power is a pioneer in hydrogen fuel cell technology. Its primary business for years has been manufacturing and selling hydrogen fuel cell systems to replace traditional batteries, most notably in forklift fleets for large warehouse operations run by companies like Amazon, Walmart, and Home Depot. This is their bread and butter segment. The fuel cells offer advantages like faster refueling times and consistent power output compared to lead-acid batteries, which is a big deal for 24/7 logistics centers. However, this core business has never been consistently profitable. To achieve profitability and scale, the company made a strategic shift to become vertically integrated. Instead of just selling the fuel cell systems, they decided to also produce and supply the green hydrogen fuel themselves. This is a massive undertaking. It requires building complex electrolysis plants and a distribution infrastructure. It's the reason their capital expenditures have soared and why their cash burn has become the single most important metric for analysts to watch. For investors using tools like Fidelity ETFs to get broad exposure to clean energy, a single company like Plug with such specific operational risks represents a much more concentrated bet. Looking at their past performance, the pattern is clear. The company has a history of impressive revenue growth, often meeting or exceeding top-line expectations. They have demonstrated an ability to sign significant deals with major corporations. This creates an expectation of a company on a successful growth trajectory. The reality, found deeper in their financial statements, is one of persistent negative operating margins and significant net losses. A year ago, the company had to issue a going concern warning, which is a formal declaration that it might not have enough capital to operate for the next year. They managed to resolve this by raising capital, but it came at the cost of issuing more shares, which dilutes the ownership stake of existing shareholders. So while the story of growth is compelling, the financial foundation has been shaky. This is why a day like today happens. Any piece of negative news or even a lack of positive news can cause investors who are on the fence to sell their positions, especially those using platforms designed for active trading, like the Fidelity trading platform or Interactive Brokers. The fear of another dilutive capital raise is always lingering in the background. Comment below what you believe is Plug Power's single biggest hurdle to achieving sustained profitability. Is it the cost of hydrogen production, competition from battery technology, or its own operational execution? Looking forward, the path for Plug Power is a tightrope walk. There are several potential catalysts that could send the stock soaring. The most immediate would be the final approval and closing of the Department of Energy loan. This would inject a massive amount of non-dilutive capital and serve as a huge vote of confidence from the federal government. Another major catalyst would be the successful ramp-up of their Georgia and Texas plants to full production capacity, proving they can produce green hydrogen at a cost-competitive price point. If they can demonstrate a clear path to positive gross margins in their fuel business, investor sentiment could change on a dime. Many investors holding Plug shares in their individual brokerage accounts, perhaps at Fidelity or Schwab, are banking on this operational success. They are looking for the moment when the company transitions from a cash-burning construction project to a cash-generating energy producer. The potential for new large-scale contracts in stationary power for data centers or in e-mobility for trucking fleets also represents significant upside. However, the risks are equally substantial and are the reason for today's 9.61% decline. The primary risk is continued cash burn. If the operational delays persist and costs continue to mount, the company could find itself in another precarious financial position. The macroeconomic environment is also a headwind. High interest rates make financing large capital projects more expensive. Competition is also intensifying, not just from other hydrogen companies, but from rapid advancements in battery technology, which could erode the competitive advantages of fuel cells in some applications. There's also regulatory risk. The value of production tax credits for green hydrogen is a critical component of Plug's business model, and any changes to that policy could have a direct impact on its future profitability. Investors considering this stock as part of their online investment strategy need to weigh these risks against the potential rewards. It's not a stock for a conservative portfolio, like one might build using Schwab Intelligent Portfolios. It is a high-stakes bet on the future of a specific energy technology and one company's ability to lead that charge. In summary, the steep drop in Plug Power stock today is much more than just market noise. The prevailing expectation is that this is a long-term play on the future of green energy. But the immediate reality is that the market is judging the company on its present-day financial health and its ability to execute on its massive capital-intensive projects. The disconnect between the grand vision of a hydrogen-powered world and the gritty reality of building the infrastructure to support it is where the stock's volatility is born. The narrative is about growth and innovation, but the stock price today is a reflection of cash burn, project delays, and financing uncertainty. Understanding this tension between the compelling story and the challenging financials is the key to making an informed decision about this incredibly polarizing name in the market. Plug Power's disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thumbs up. Don't forget to like, comment, and share this video to support the channel. Hearts, thanks.